Hey everyone, and welcome back to the channel. Today, we're tackling a question that so many aspiring investors here in the UK ask themselves: stocks versus property. What should beginners choose? It's one of the biggest money decisions you'll ever make, and honestly, it can feel overwhelming when you're just starting out. On one side, you've got the stock market, easy to access, low starting capital, and the potential for long-term growth. On the other, there's property, tangible, familiar, and often seen as the safe way to build wealth in the UK. But which one actually makes more sense for beginners? Do you need thousands saved up? Is property really safer than stocks? Can you build wealth faster with one over the other? In this video, we're going to break it all down in simple, practical terms. We'll look at how much money you realistically need to get started, the risks involved with each, the potential returns, the time commitment required, and which option might suit different types of beginners. By the end of this video, you'll have a much clearer idea of which path aligns with your financial goals, lifestyle, and risk tolerance. So grab a cuppa, get comfortable, and let's dive into the great UK investing debate: stocks versus property. First and foremost, let's discuss the concept of property. For a considerable number of individuals in the UK, owning property is viewed as a secure, long-term investment, tangible asset. You can indeed see, touch, and frequently live in it. This distinctive feature can provide many investors with a sense of security. Potential for capital appreciation. Historically speaking, property values in the UK have demonstrated a propensity to increase over time, particularly in well-established areas. Rental income. Naturally, if you're a landlord, you can generate a consistent income stream from the rental of your property. Leverage. With the assistance of a mortgage, you have the opportunity to buy a property, essentially acquiring a larger asset with a more modest initial investment. Inflation hedge. Undoubtedly, property can often maintain or even enhance its value during periods of inflation. In summary, the idea of owning property in the UK provides significant benefits, ranging from tangible assets and capital appreciation potential to rental income and the capacity to leverage. There is no shortage of reasons to consider this investment choice. The cons of owning property: high initial costs. An expensive property, including fees and taxes, can put a substantial burden on your wallet. Initial debts. When you buy a property, you may need to make substantial initial payments, such as closing costs, which can create debt. Limited liquidity. Property investments can be more volatile than other assets, making it difficult to access your money quickly when you need it. Ongoing costs. Like with any investment, property owners have to deal with ongoing costs such as maintenance and repairs, insurance, and property taxes. Potential tenant issues. Although you can choose your tenants carefully, there can be unexpected issues that arise, such as rent violations or tenant disruptions. Market fluctuations. Although the housing market is generally stable, it can still fluctuate, as we've seen in the past. Increasing interest rates. When interest rates rise, the cost of borrowing can increase, impacting the value of your property and potentially your monthly mortgage payments. Loss of potential income. While property can provide rental income, it can also reduce the potential income from other assets, such as stocks or bonds. Maintenance and repairs. Property owners often have to take care of the upkeep of their homes, which can be time-consuming and expensive. Anchored income. Property investments can provide a steady income, but they can be less flexible than other income streams, such as freelancing or side hustles. Diversification. Property investments can be a useful way to diversify your portfolio, but they should not be your sole source of income. All right, so that's a property right there. Let's shift our focus to the other side of the coin: stocks and shares. The cons of stocks. Higher entry point. Investing in stocks can require a larger initial investment compared to property. Risk. Stocks can go up and down in value, increasing your potential for loss. Volatility. The market can be highly volatile, making it difficult to predict future performance. Dividend risk. You might not receive the same consistent income from dividends as a property owner. Short-term losses. Stocks can experience substantial losses over the short term. Taxes. Stock investors may be subject to increased taxes when trading. Limited liability. Though shares are personal property, they are not personally liable for any financial debts or obligations once they are sold. Risk of lending. Investing in stocks may involve lending your funds to a company, making it a higher risk endeavor. Diversification. While stocks can offer diversification benefits, a single investment can still be exposed to a wide range of risks. Potential for low returns. Historically, the average return on stocks has been lower than on other forms of investment. Long-term commitment. Stock investments can be long-lasting, with potential returns lasting for multiple years. Passive income dividends. While dividends can provide a steady income source, they might not be as lucrative as property income. No landlord hassle. You don't have to worry about maintaining and fixing your rental properties, as the landlord does that. These are just some of the pros and cons to consider when deciding whether stocks or property is the right investment for you. There are many other factors to take into account, such as individual financial goals and risk tolerance. So it's always best to research and consult with a professional before making a decision. There are, however, some drawbacks to owning stocks. Volatility. Stock prices can experience significant fluctuations in the short term, making it a bumpy ride. Knowledge and experience. Understanding the complexities of companies, markets, and various investment vehicles requires time and extensive research. Emotional decision-making. It's easy to get caught up in the excitement of the market or succumb to panic during negative times. No tangible assets. You own a piece of a company, not a physical item that you can see or touch directly. Risk of loss. Despite the potential for higher returns, you can still lose money if you don't diversify your investments or make wise decisions. Time commitment. Investing in stocks requires regular monitoring and analysis of market performance and company dynamics. Concentration. Stock investments can be highly concentrated in a small number of securities. This risks exposure to market instability and economic downturns. Government regulation. Stocks are subject to the same government regulations and taxation as other investments, making them a popular choice for individual investors. Limited liability. Owning stocks means you are personally liable for the company's debts and assets. This can be a major disadvantage if the company experiences financial difficulties. Short-term focus. Stock investments are often seen as short-term instruments, with long-term returns being the primary goal. However, long-term investments can also provide significant returns if executed well. So, back to our original question. What should beginners choose? The answer, as with most things in finance, isn't a simple one-size-fits-all. It really depends on your personal circumstances, your financial goals, and your risk tolerance. Here's some general guidance. If you have a large sum of money saved, are comfortable with long-term commitments, and are happy to be hands-on or pay someone to be, property could be a good option. It can offer stability and tangible assets. The voice you selected does not support this language. Please click the upper right corner to switch to another voice. If you have less capital to start with, prefer more flexibility, want to diversify easily, and are comfortable with market fluctuations, then stocks might be a better entry point for you. You can start small and build up. Many seasoned investors choose a combination of both. Property can provide a stable base and income, while stocks can offer growth potential and liquidity. My key advice for beginners in the UK is this. 1. Educate yourself. Learn as much as you can about both options. The voice you selected does not support this language. Please click the upper right corner to switch to another voice. 2. Define your goals. What do you want your money to achieve? When do you need it? The voice you selected does not support this language. Please click the upper right corner to switch to another voice. 3. Assess your risk tolerance. How comfortable are you with the value of your investment going up and down? The voice you selected does not support this language. Please click the upper right corner to switch to another voice. 4. Start small. Start now. Don't wait for the perfect moment. Whether it's a small monthly investment into a diversified fund or saving diligently for a property deposit, just begin. The voice you selected does not support this language. Please click the upper right corner to switch to another voice. 5. Consider professional advice. A financial advisor can help you tailor a plan to your specific situation. Ultimately, both stocks and property offer fantastic opportunities for wealth creation in the UK. The best choice for a beginner is the one that aligns best with their financial situation and comfort level. What are your thoughts? Are you team stocks or team property? Let me know in the comments below. Don't forget to like this video and subscribe for more insights into personal finance and investing. See you next time.